Let's talk about one of the most boring sounding things in bookkeeping that quietly ruins everything if it's done wrong. Your chart of accounts. And if you've ever opened your P&L and thought, why does this look useless? There's a 99% chance your chart of accounts is the problem. Quick intro before we dive in. If we haven't met, my name's Jared Myers. I own Wasatch Bookkeeping, and I've been doing this for about 3 years now. And a huge chunk of my work is coming into businesses after things are already messy and figuring out why the numbers don't make sense. Spoiler alert, it's almost always the chart of accounts. So let's fix that. So part one, why your chart of accounts sucks. Most people don't design a chart of accounts. Instead, they just add accounts as problems show up. Oh, I paid John Doe, new account. Oh, this feels different, new account. Oh, QuickBooks suggested it. Sure. Now you've got 80 accounts, half of them mean the same thing, and none of them tell you anything useful. Your chart of accounts is not a list of vendors. It's not a transaction log. It's a reporting tool. If it doesn't make your financials easier to read, it's failing. Part two, what a chart of accounts should do. A good chart of accounts answers questions quickly. Questions like, where is my money actually going? What's costing me the most? Is this business getting healthier or messier over time? If you can't answer those in under 60 seconds from your reports, your structure is wrong, not your math. So the goal is simple: fewer accounts, clear purpose, consistent rules. Part three, core structure that works. Start with clean, predictable buckets. On the balance sheet, assets first, ordered by liquidity, then liabilities, ordered by how they get paid, then equity. On the P&L, revenue, cost of goods sold, so only things directly tied to what you sell, operating expenses, including overhead, admin, tools, people, other income, and other expenses at the bottom. If you like account numbers, great. Use them to mirror this flow. If you don't, that's fine too. Structure matters more than numbering. And one big rule here: if an account doesn't clearly belong on a financial statement, it doesn't belong on your chart of accounts. Part four, rules that keep it clean. And this is where most people mess up. You need written rules for edge cases. Examples: vendor names never equal accounts. Costco receipts, split only if it's obvious, otherwise one category. Takeout is dining out, not groceries. If an account has fewer than a few transactions a month, merge it. And yes, you can have miscellaneous, but if something hits it twice, it graduates or it gets reclassified. Consistency beats perfection every time. Part five, how to review monthly. Here's the habit that keeps your chart of accounts from breaking again. Once a month, scan the P&L top to bottom. Look at the top three expense categories. Ask, is this how I want my money to be showing up? Then make one adjustment, one rule, one merge, one rename. That's it. Your chart of accounts isn't a set it and forget it thing. It's a system you maintain so your numbers stay useful. And if this video helped you rethink your chart of accounts, like the video, subscribe, save it for the next cleanup. And remember, clean books aren't about more detail. They're about better structure.